Hello everyone, today is April 19th and this is excitingly our first session of the Wyckoff Trading course, part 1, the analysis. So what are we gonna do here administratively? Well, first of all, there are two types of students in this particular session. The ones that already signed up for this course, and I'm gonna address a lot of the information to you, so please pay attention. And then there are guests, because this is an open door class today. So for those of you who will be signing up with us after this session or during this session, I would like you to go to our website, wyckoffanalytics.com, or if you have any questions, contact us at wyckoffAssociates@gmail.com, and we'll gladly answer any questions. We still have a discounted pricing for this course. It's at $850. It's only 12 sessions instead of 15. Right away, I want to address this question. People would usually ask, well, in the spring and fall semester, you have 15 sessions, and in the summer semester, you have 12. So what's the difference? We're going to cover the same material. It's just that we're going to pay less attention to the exercises. We'll definitely have those, but not as many. And we're just going to cover everything in 12 webinars. For those of you who are alumni, and I've seen quite a few have re-registered for this particular cycle, and I actually really like this setup for you guys, the alumni of WTC course. Summer is a really good time to repeat this material because it's at the lower price, fewer sessions, and yet you're going to go through the same material and absorb more information. And for those of you who are interested, our payment plan is at $283.33 per month, to cover all of the sessions, and just use that. There's going to be a homework. This is very, very standard for us. I've been teaching for the last 10 years plus, and we've always had homework, so this is nothing unusual. I will ask you guys to submit only one file, and we'll talk about this during this second session. It's very important, very imperative for you to send me just one file, and in these formats, either PowerPoint, PDF, or Word doc formats. Please do not send me zip files. Please do not send me, 6, 7, 8, 10 charts that are separated. It's just not efficient for me. I also would like you to remember to put your name, the course, and then the number for the homework. This is going to be our way, again, of increasing efficiency as to how we deal with the homework. Send those to wyckoffAssociates@gmail.com. A lot of our classes are going to be very, very interactive. So what does it mean? It means that you will participate in the discussions with me of the specific chart. So you should have a built-in microphone. Please make sure that you have that. Please make sure that you test that before the class. And usually, somewhere in session number 3 or 4, I will volunteer people, or people will volunteer, and we will have some kind of discussion on the homework or on the class exercise, so please be ready. And you don't have to be necessarily a very interactive, very active student in this class. I'm totally fine with somebody who comes to the class and diligently listens to all of the recordings, diligently goes through all of the homeworks. I know that you guys are busy. Sometimes there is really no desire, to be very interactive. And yet you could submit the questions with each of the homeworks. You could show me what kind of problems you have analyzing the chart and so on and so forth, and we'll dig into that. All of the recordings and slides from these sessions will only be available for students who already signed up or who's going to sign up. For those of you who maybe not being able to go through this whole session, this session is going to last for about 2.5 hours or so. We are recording this session, that's number one, and it will be posted on our YouTube channel, Wyckoff Trading Methods, so check it out. All right, as usual, everything that we discuss in these classes is for educational purposes only. Please stop your recording and read the disclaimer in full. And we're going to start with some of the free products, 3 offerings that I would suggest for any guests. If you're not familiar with Wyckoff Analytics .com work, that is the weekly newsletter, completely free. And during, in these newsletters, we are usually covering the market. This is our latest thought on the market. We usually will have some kind of videos that are free videos for you for the weekend viewing, and then also we'll have some kind of blogs, whether they are on crypto, whether they are on scanning, whether they are just on Wyckoff principles, or maybe on the anatomy of the trade. You could definitely enjoy those. Our YouTube channel has quite a lot of videos. Each week we have 2 to 3, 4 videos that we put on there. Please go ahead, check it out. Usually people have a really good response about the videos that we post, and that kind of gives you an idea of what we do. And there are quite a few series there. I mentioned power charting, I mentioned anatomy of the trade, Wyckoff crypto discussion, and then any type of other offerings that we have. Also very popular with our students is our Twitter. And then usually on Twitter, we post bias game, which is a teaching tool for us. This is one of the students' favorite homeworks and exercise, especially in the WTC2 practicum class, where we dissect the bias game into such a small details. And then obviously any type of announcements or market analysis, we always tweet there. All right. Now let's talk about the curriculum. And right away, this question about the recording here. Yes, for those of you, again, who cannot go through the whole session, we will be posting this session on YouTube, so don't worry, and check it out on our YouTube channel later on. So 12 sessions. For the first 4 sessions, we'll be talking about the market structural analysis. So we'll talk about the very fundamental Wyckoff method concepts, a concept of the change of behavior and change of character, and how the price structure or price structural environment changes with that. We also will discuss, once we go in the non-trading environment into the consolidation, what kind of Wyckoff events and what kind of Wyckoff phases would we go through as we go through the trading range. And obviously, our main idea behind our analysis is to identify 3 things. First one is, what is the bias of the trading range that we are currently in? Secondly, we want to understand the timing. When is the price going to leave the trading range? And thirdly, we want to understand the character with which the price will be trending, whether it's a trend up or a trend down. Those are very important elements for our trading decisions. And that, on the top of the price structural analysis, we're going to combine with the volume and price analysis. This is a visualization of effort versus result, and this is probably the most important concept in chart reading in the Wyckoff methodology. Is the effort and result are in the harmony or disharmony. And we're going to look at those two through the prism of volume and price interaction. We also will go into a lot of details of the volume and spread analysis, bar by bar analysis, and also swing analysis, so swing by swing analysis. We'll talk about the volume patterns in different Wyckoff phases of the any consolidation, and we'll look at some of the historical analogs, or rather, I will show you how to use historical analogs that you could see on the chart in order for us to make a better decision about our analysis. Then the next block of knowledge is on the relative and comparative analysis. So this is something well known to a lot of you guys, but how does this relate to the Wyckoff method? How does this relate to the price structural analysis? And then also, are there any specific nuances that the Wyckoff methodology could bring to the table when we are discussing what is stronger or what is weaker relative to the market, relative to the sector, or a group, or maybe to peers? So I'll show you some of the kind of like nuggets that we have created in the body of knowledge on relative and comparative analysis. I'll discuss a sweet spot, a specific sequence of outperformance or underperformance that would short-term predict the future movement of the pricing. And then we'll talk in session number 11 about the trade management. So where are our entries and exits? How do we originally place the stop loss, and how do we move the stop loss? How do we scale in or scale in out of the position? So all of that will be briefly discussed in session number 11, and then we would develop this more in WTC 2 in the practicum. Once you have a really good grasp for the analysis. And then session number 12, as in all of our cycles, last sessions is devoted to your Q&A, so we will be collecting all of your questions, putting them in the bucket of questions, and saving them for the last session. Having said this, in a lot of cases, I would take some of the questions that come from your emails, and I would definitely address those also during classes. So today, what are we going to do today? So we just went through the introduction. We'll talk briefly about the homework for those of you who already signed up, or for those who's going to sign up. That is going to be Jim Fortis' Anatomy of a Trading Range. Then we're going to go through the market update, so stick around for that. We're going to start with the Bitcoin, as Bitcoin had this shakeout over the weekend, so we'll talk about where we are with that. And then we'll go into our initial body of knowledge. We'll talk about Richard D. Wyckoff himself, who he was, what he has created, why is it important to us. Then we'll discuss one of the main heuristic concepts in the Wyckoff method. That is the concept of the composite operator, or the composite man. I'll show you some of my trades. Those are actual trades, some of them in cryptos. Twitter is going to be the trade, a long-term trade, and also a swing-term trade, and then the intraday trade in NASDAQ. And then we're going to come back to our body of knowledge, and we'll talk about the price cycle model. And this is going to be a foundation for us to understand how the price moves and what are the reasons why the price moves the way that it does. And that is all going to be based on the behavioral market analysis, the analysis of the institutional hands versus retail hands, strong hands versus weak hands. We'll discuss who the market participants are, what are their attributes, what do they require, and what does it create as a behavior just based on that. And then we'll talk about some trend characteristics, but not to the degree that we will cover this in session number 2 or 3, where I'll give you a little bit more details on the trend characteristics. And then session number 2, we're going to continue with the price cycle studies, but we're going to dive in into very, very important topics on the change of character, change of behavior. We're going to discuss attributes of the accumulation and distribution. If we have time in session number 2, we'll discuss reaccumulation and redistribution. If not, we're going to move it to session number 3. Then we'll talk about the phase analysis that is in the consolidation in the trading range. And then you're going to have your first chart homework. This is where I'm going to give you some charts of Home Depot, and you will have to label those based on the studies that we've done in the previous 2 classes. Again, this session is being recorded, so we will be posting it on Wyckoff Trading Method YouTube channel tonight. So make sure that you check it out if you are not going to cover this whole class. All right, so here is our homework. Again, for those of you who signed up or who's going to sign up, you can find this article on our website under the free materials. And actually, I would recommend it to anybody to read. In my opinion, everything what I've read on Wyckoff, including Hank's Pruden book, including Bruce's blogs, including David Wise's book, and so on and so forth. And you could name probably any Wyckofian, that is in the lineage since Wyckoff himself. I think Jim's article is probably one of the most developed article in terms of the understanding and sequentially as to how the material is being presented. And I know that Hank tried to create, additional article to that, and I think that Jim's is just like Jim just nailed it. Ooh, Kent, did it really happen? I'm not aware of that. Okay. Well, I'm not going to comment on this. I just have some comments from Kent here. We both knew. No. Okay, so Kent, I'm going to have to come back to this. This is definitely such a curveball for me. So just read the article. Make sure that you go through all of it. Make sure that you make some notes. And then come back to the second session prepared with that knowledge. And then, after some of the disturbing news that I'm receiving from some of the students here, I'm going to have some conversation with you about Jim. All right, market update. Let's go into that. So let's talk about Bitcoin right away, because I was trying to have a break over this weekend, and then this shakeout happens, and obviously, students start contacting me and asking, what's going on, what do you think about the structure of the Bitcoin, and so on and so forth. So here are my very quick observations about Bitcoin and just crypto space in general. Looking at the uptrend since COVID-19 low, and I'm not showing here the whole uptrend, how would you characterize this uptrend? Is it aggressive? Does it have a lot of momentum? What about the reactions? Are those deep reactions or not deep reactions? And I would probably answer those questions with a lot of conviction, because as we are seeing higher highs, higher lows, there is not a lot of reactionary mode. There is not a lot of supply. If supply is coming in, it's quickly being absorbed, and then the price starts moving up. So this is a very aggressive move up. Usually, this type of aggressive moves are going to continue to the upside after some pauses. Okay, well, we have the first pause here. This is our change of behavior reaction into the automatic reaction. Supply definitely is coming in, but behind that, there is also some increase of the demand. And then as we're testing those lows again, we're seeing how supply is diminishing a lot. And that is suggestive, again, of a rally, at least into the high of the trading range. That was the call at the time. Now, we are definitely seeing a really good breakout on Elon Musk news. Actually, there were two places where Elon commented. And in both cases, there is quite a lot of demand that is coming in. That produces a really good move to the upside. Later, momentum is decreasing, and that suggests some kind of reaction. Now, this reaction becomes very important. What about it that is so important? It's the character of the reaction. So we kind of could see that the reaction starts to develop almost the same way, identical way as the one before. So that again suggests presence of the demand, and we're seeing that there is no follow through after that. Excuse me. Lost my voice there for a second. So there is no follow through after that. There are some attempts to continue, but all of them are just demand tails. There is no conviction to the downside. And that is, again, showing the strength of this trend. Multiple attempts on shortening of the thrust to overcome this level, and then a shakeout. Obviously, for those of you who are familiar with this crypto space, you probably will refer to any type of news that have happened over the weekend. I'm just reading the chart, so whenever something happens, I want to know that something has happened, but I don't necessarily need to understand the macro fundamental news. I want to see the reaction of market participants and judge the market by its own action. So what do we see here in the shakeout? Well, obviously, it's a big bar. That's number one, right? It's the size of this bar obviously reminds us of how other changes of behavior have started. So at least at the minimum, we could say that we are having a change of behavior here, and that would be suggestive that we might have more of some kind of continuation of the trading range with the resumption of the uptrend later on. And that would probably be the most bullish scenario. And under this scenario, we might even think that this is a potential phase C. The second scenario here is that we might have some kind of continuation. Although, again, look at the tail, right? What does it tell us? On the intraday basis, the price was pushed down, and yet it recovered so quickly. And that's behind, again, one of the highest volume signatures on this chart. And this is suggestive of the emergence of the supply, but also it is suggestive that demand was there. And therefore, this tail right here. So this shows that there is some value even at this level of price. Another less bullish scenarios would be undercutting of this low, and we just tested it, and then going to about this level of 47, 43, finding support here, testing, and then recovering from here. That also could be interpreted as potential phase C of the reaccumulation. Another reaccumulation scenario under which we still could be long-term bullish, and I do believe that they share that we should probably hit 100,000 for Bitcoin, is a scenario where we actually go through this level right here, and then we still stop in the area of the support that was created before by the stop in action here, and then we recover from here. So all of those are just complex variations on a possible reaccumulation. The key here, I think, is in tactics. If you're a long-term investor and you got into Bitcoin at much, much lower prices, would you be selling here? Unlikely. Unlikely because the trend is still on. There are still higher highs, higher lows. That's number one. Secondly, even if most recent lows are being violated, it doesn't necessarily mean that there's going to be a violation of the major trend. If you are a swing trader, then it's easier, right? Because you're basically trading all of the swings up and down, right? So here is your swing trade, here is your swing trade, here is your swing trade, here is your swing trade that did not materialize well, and you might have some kind of hedges to the downside. And if you're an intraday trader, then for sure, this increase in volatility is really, really great for you. Okay, well, I think that's it for the Bitcoin, at least for now. Maybe we'll come back to this later on in the anatomy of the trade. Let's talk about the stock market. So here's the Dow Jones Industrial Average. This is a monthly chart. This is one of my favorite charts that I show that is the long-term chart. And here you could see how we are still in this uptrend channel. And this is a logarithmic scale, I believe. And we see how the price is well contained within this channel. And within the channel, we have different mega structures. We have the structures that are consolidations. And usually, those consolidations will be resolved with some kind of up move. And this up move will be related to what? It will be related to a specific generational rally, which we're calling here a silent generation rally, baby boomers generation rally, and millennials generation rally, obviously attributed to specific generations that are increasing their um, revenue and consumption in the economy. And in a lot of cases, because the US is the consumer driven economy, that's what supports this type of rallies. And currently, we are in the millennium generation rally. And it's been unfolding for about 12 years, where the previous two major mega rallies were unfolding for over 25 years. So in my opinion, we're still pretty much in this pattern. We're still in the pattern of a mega structured rally based on the millennials generation consumption and revenue that they produce. And they're not even fully into their uh, full power, revenue generation. So it kind of makes sense that we still will go up from here long term. Now, short term, we could have situations like 1987. And look at 1987. This was the most dramatic one-day drop in the market history. And yet, when you look at the long term, it doesn't look that bad. It took some time to recover from there, but we have. And so is with COVID. I mean, like we're already at highs and even above. So I'm fully expecting some kind of long-term continuation. It's all about tactics on the rotation. It's all about tactics on short-term cyclical reactions, which could last for some time and could produce up to 20% decline in the rally, long-term rally that we are in. And then one of the other questions that we have is usually, well, what about the breadth? I mean, this is kind of like the next question after we address the long-term trend. And as you could see, this is the New York stocks above 200 moving average, a very useful breadth indicator. And I just want to point your attention to just one idea on this chart. Actually, two. Idea number one, when we start a new cyclical uptrend or secular uptrend, we usually will have the market broadly participating in the first rally of that huge secular rally. Why? Well, because everything is cheap. Everything is cheap after depressed prices and after meaningful corrections. And by meaningful corrections, I don't mean cyclical corrections that you could see like smaller corrections within an uptrend. I mean meaningful corrections like COVID-19 correction, like 2007, 8, 9 correction. Those are usually have a lot of capitulation by institutional types. And when we see that, that's when the prices are depressed and depressed seriously. And usually out of those, the first leg up is going to have those broad breadth characteristics where everything is participating in the rally. And then after that, we're going into very standard uptrend breadth picture where we're going to have some declines. They're going to be associated with the declines in prices. And then we're going to have recoveries. And we don't necessarily have to stay at the highest level. Usually it's the first leg up that's going to get us to like 90% of the stocks that are going up just because institutions are aggressively buying. After that, we might come to some high numbers and we might stay there for a while. And while we are staying here for a while for the breadth characteristics, look at what's happening with the actual price. The price is actually going up. So whenever you hear something like, well, the market is overbought, the breadth does not support it, bear in mind that in a lot of cases, during a lot of uptrends, this is going to be a big misconception. And even the breadth at a lower level could sustain the uptrend, and specifically cyclical secular uptrends, for quite some time. And in every case, we see that. We see that once the price makes some kind of high in the breadth, we could still see continuation of the price movement to the upside. It just means that there is a rotation or mini rotations that are happening. Something is being dropped off by institutions on profit taking, and something is being picked up. But overall, the money still works in the much larger uptrend. So if there are any concept from this chart, it's those two that I want you to remember. Now let's look at NASDAQ. And we've discussed NASDAQ for quite some time, with an idea that we are in the uptrend and we don't see any distributional signs in NASDAQ or any other indices for this matter. There was a very clearly defined climactic run into September 2nd high. That created an overbought condition and structurally created the buy-in climax. It's very evident here how the price is in the climactic run. And then we are seeing a change of behavior bar, which was September 2nd, and it comes with a lot of supply. This was the highest supply since COVID-19 distribution, which happened on the way down. We're expecting a reaction here, a change of behavior reaction, and then attempts to go up, which don't materialize into anything significant, suggesting that there's going to be a continuation. This continuation sees supply decreasing, therefore a rally. The rally fails as a lower high, and then we are retesting, and that's what creates this whole trading range. Well, now look what happens next. We don't have a lot of momentum on the way up in this area of the uptrend. In fact, look at the volume signature. It's diminishing. What does it tell us? There is not a lot of participation in the technology stocks at this point. And if there is, there are some moments where selling as a profit taking happens. And the key here for us is to understand that there is no follow through to the downside, which is bullish. So the trend is still on. A change of behavior suggesting another trading range. And then this was a very interesting moment. This was, somewhat challenging in the way how NASDAQ was rotationally much, much weaker than anything else. And obviously this, chart shows to us that even though supply has increased, there was an increase in the demand signature as well that stopped the price from moving further down, right on the support level where the price was supported before on this stride. And then we go into testing where supply starts to decrease. We are again testing the support of the up channel, and from there we are going up. Now, there are a lot of questions about why we're going up, why we're traveling up when the volume signature is decreasing and demand is decreasing at the same time. Well, we're moving up only because supply is decreasing even more. And there was such a absorption of the supply in this area that has suggested that supply is exhausted. And after the test, we are moving up without a lot of effort by the demand. And that's what's going on. Well, if we would look at this up channel, we probably would be thinking that we need to have some kind of smaller resistance around 1400. I'm sorry, 14,000, and that's exactly where we're stopping, at least for now. And then some kind of continuation into a similar look or similar price structure where we have the climactic run that leads us to the overbought condition where we're going to experience the buying climax, and then we're going to stop again, and we're going to have some kind of reaction. So that's kind of one of the scenarios. How would we confirm this scenario? Would any of our Wyckoff method tools show us that we could potentially go to this area? maybe above 15,000, maybe to 16,000 or so. So let's look at the P&F counts of the NASDAQ 100. So P&F chart is just a representation of the volatility. Sometimes I also define P&F charts as the chart of cumulative effort versus cumulative result. So for instance, you could see here how at the bottom we have the volume signature for the whole chart. And we could think about the volume signature as an effort that appears at this particular price structure. So for instance, into the climactic action, we're seeing how we have a volume spike, which is suggestive of the presence of the supply. We could expect some kind of reaction out of this. So this is our cumulative effort versus cumulative result. And why cumulative result? Well, because what P&F chart does is it shows you the whole volatility of the even intraday price action. And we could see that from this area right here. This is a very, very important concept here for us to remember. If we would look at the vertical chart of COVID-19 low, we would see only about 10 days that are forming the trading range. Whereas on the P&F, because of the volatility, we have more swings up and down. And that's what creates the count for us as we're measuring this causality. And we're getting here a number above 16,000. And that's exactly where we saw the overbought condition on the vertical chart. So this becomes a very, very important area for us of interest. Well, another idea for the P&F charts is that their regional count usually would be confirmed, if this is a correct count, by other reaccumulation counts as the price goes up. And we're seeing that in both cases, for both of the trading ranges, we're kind of seeing again the numbers are showing anything above 16,000. So with the P&F cause and effect calculations, we are confirming this picture. We're confirming that there is some kind of potential target around 16,000 or slightly above that could potentially lead us into the overbought condition and into the buying climax. All right, well, now let's switch gears here and we've talked about the trend, we've talked about the cause and effect. Let's talk about tape reading and let's talk about interpretation of what we're seeing on the chart, and specifically what do we see in the latest price action. But I'm going to start with the previous reaccumulation. The selling occurs on the big change of behavior bar. We're seeing that in the volume signature as well. As the price goes down, we're seeing supply tails, volume is increasing or being still heavy. So that is suggestive of buying. So not a lot of progress close to close, or let's say close below the low. That usually on the increased volume signature would suggest increased effort and less ability to push the price down as the initial selling has occurred. So demand is present. Then on the second retest, we're seeing how supply is so much less, and there is definitely some buying. We're seeing this from the tails as the price on the intraday level tries to commit down, but yet unable to do so, and it's being lifted up into the close. So those are all buying characteristics. At the top of the rally, climactic bar with some signs of the supply, and then the next bar, the small bar, also on the same effort does not produce any result relative to the previous bar. So that is suggestive of the resistance that is occurring in the vicinity of the bar that had this majority of selling before. That's very common. We also see that selling come at this bar right here. I should have placed it here. So at the same level, selling is occurring, and we're seeing how different those reactions are from those two places. we're seeing that in the second case, we do not have a big follow through, especially after this most important bar in this whole formation. Uh, Effort is increasing, but price is not going down. So that is suggestive that demand is absorbing supply and that we're going to have prices going up. This is a very typical tape or chart reading analysis that we do in the classroom. I usually, spend a lot of time on this. We have a whole exercise devoted just to that concept, of how do we read volume and spread? How do we interpret this? And what I'm finding is that there are quite a lot of, struggles that people usually have around these concepts. But the only thing that I would suggest is just a lot of practice, and not necessarily practicing with the live charts, but actually going away from the market, not being distracted by tick up and down, but more about being focused, concentrating on the actual chart tape reading rather than, getting more emotionally involved in every tick up and down. As we go up, there are quite a lot of spots where selling is occurring. And those are just, rotational profit taken by institutions out of the growth theme and into the value. And then finally, we're seeing first signs where the reaction starts to develop more. So that is suggestive. Well, first of all, this is a change of behavior, and that is suggestive of the change of the environment from an uptrend to a trading range. And initially, this is how we would interpret our trading range, a horizontal structure where after we see some buying at the bottom, a rally overcoming the resistance, suggesting that this is still strength for the overall trading range. And then obviously this kind of nasty reaction comes. But even during this reaction, we're seeing something like this, where the tail suggests that there is a lot of buying going on that particular bar. Inability to commit down also suggests buying. And then once we break to the downside, look what happens after the bar where we see a lot of selling. Spread is diminishing to the downside and volume is increasing. Why would this spread diminish? Why would we have this tail right here on the increased volume signature as we go down? Well, because the opposing force is most definitely there and it's increasing. And it's suggestive that buying is happening. And right away, the next day acts as a confirmation of the idea that the buying and the demand is present, and all of the attempts to go down fail on the intraday level, and we're closing way into the body of the previous bar. Next bar, no result. We don't have any commitment. And look how supply is dropping drastically right away. Again, those are all elements of our volume and price chart reading that we will be studying in these classes. Next bar, ease of movement on lower demand signature, and yet we are overcoming all of these three bars. So that is suggestive of strength. Loss of momentum, and right here I was extremely bullish. I was thinking that we're going to have a continuation right away, but the price required more testing. More testing of what? More testing of this bar right here, this bar right here. So basically this level. And as we see again, this bar tries to commit down. It looks very bearish. It's what I say, looks bearish, acts bullish. There is no commitment below, and supply is definitely lower than, let's say, somewhere here in this area. Another attempt and another attempt show more of the same diminishing supply characteristics, presence of the demand, and somewhat absorption of the latest supply, and more importantly, ability to hold above this level right here, where we stopped once, we stopped twice, and now we're stopping for the third time. And then a rally. And again, the rally without a lot of volume signature. We'll talk about this pattern. I'm going to give you a specific exercise on that so that you will remember this concept for a long time. The price can't travel up without significant demand presence if supply is totally exhausted. And we'll talk about why and how we would see this on the chart. Okay, latest price action. We see two down bars here, 1 and 2. Both have increased supply signature. So what does it mean? The biggest question that we need to address with those two bars where we see increase of the supply is what is the result of this most recent selling? Well, what do you guys see here? Do we commit below the last commitment to the upside? No. What did today's bar produce? Did we violated any significant support levels? And probably the most the closest support level is going to be somewhere here, and we couldn't do that. And supply just ever slightly diminished. So I think that we're still trying to go up here. There is a chance of the continuation. We definitely would be on the lookout of any type of bar like this, where we truly commit below this level and below any type of up commitments that we've had before. It's only a bar like this that would suggest to us that we're still in the trading range and that the price might come back, retest the support. So be on the lookout for that. But if that doesn't happen and we're basically in this area and we are trying to consolidate, then without any violation of the support and commitment below, then most likely we're going to continue to the upside. Okay, well, that was it for the market update. Vincent is asking, will you be going over gold and silver? So I'm just going to tell that gold has just had exhaustion of selling, test, and the breakout is the confirmation of the idea that we're going to have the rally into the resistance. And silver is right behind it because it's actually was behaving much better during the consolidation. It lost its relative strength to the gold, but definitely up there with gold. So we're in the rally mode for gold and silver, and we just have to see what kind of rally we're going to have and where it's going to stop. Okay, for those of you who are interested in the market updates on a weekly basis, a Wyckoff market discussion together conducted by myself and Bruce Fraser is all about application of the Wyckoff method. We usually would go through the current market analysis where for the first 20, 30, 40 minutes, we only talk about the markets. We talk about gold, silver, we talk about oil, Bitcoin, so the major assets. Then the next segment is the stock selection. So we want to give you somewhere close to 20 ideas, or at least comment on 20 plus stocks. Either those are going to be picked up by us, and we're going to be usually picking those up through the top-down approach, where we're going to go through the sectors, industry groups, and then stocks. Or you will, guys, let us know what stocks you are interested in, and we will, put our analytical eye on those, and we'll go through the price structures there. We also would have other segments, like for instance, there is an anatomy of the trade segment that is very popular with students. We're currently live trading the DBA, which is the agricultural ETF. So that was a very interesting trade. We have segments on student charts where you guys submit your work with Wyckoff labeling and we comment. And also we have a scanning segment where Johnny Scan, our contributor for Wyckoff Analytics, goes into specific scan algorithms for the current market context. So very, very fascinating. So please check it out. And this Wednesday at 3 p.m. Pacific, we will have a free webinar of that class. And by the way, which reminds me that tomorrow we also will have open doors to the practical. So check that out as well. All right. For those of you who would like to see what we are looking at, or communally, we have created communal Wyckoff watch list. So this is done by students and created by us, teachers. This is where students add to the list or take some stocks out. And usually there are two characteristics that we're looking forward, to put on this list. We want to see some kind of emergence or sustainability of the price action and relative performance. Those are the two main components for our definition of which stocks should be on this communal Wyckoff watch list. This is a completely free offering to all of our students and to those who are interested. You can find it on stock charts, and you could also find it on our website. Also, you could download it from our website as as a list of symbols, and then put it into your software. So a very interesting offering. Now let's go into the Richard D. Wyckoff story. Who was here, and why is it that we are paying attention to him? And I'm not, well versed on his life. I am definitely much more versed on the tools, the knowledge that he has created for us. So I'm always referring to some sources for you to read on his biography. And uh, one of the greatest people who tell us the story of Wyckoff is Stella Atsoba. Stella was kind enough for us to present in the Best of Wyckoff 2019. By the way, all of our Best of Wyckoff recordings are free right now, so check out our website under the on-demand offerings. And Stella was just superb. She wrote an article in Stocks and Commodities on Richard D. Wyckoff. It was, 5 parts, if I'm not mistaken. Very fascinating read. So please check this out. Also, you could check out the Best of Wyckoff, and you could also check out the power charting episodes with Bruce Frazier, where Stellar, talked about Wyckoff and Jesse Livermore. So check those out. Wyckoff was a very interesting figure in our world. He was an editor. He started his career when he was a boy. He was a running boy at the box shop. And then he started studying the best principles of the modern stock operators of the time. So those were Jesse Livermore, James Keane, JP Morgan, and so on and so forth. And he codified their tactics, and he put it out there for the public to have it. Now, obviously, it required a lot of studies, a lot of time to create this material. So as he was creating that material and going through the studies of the market, he had different products. So one of them was the publication called The Ticker. Here you could see his interview or the article with William D. Gann, which I thought was pretty cool. He had a newsletter. He was an editor, as I mentioned. He has created the Magazine of Wall Street, where he published his own material, and also he had a whole staff. He has written quite a few books. Now, a lot of people ask me, well, which book by Richard D. Wyckoff would you recommend? I would not recommend the books by Wyckoff himself. I would recommend the books that explain Wyckoff methodology in a more modern language. For instance, for the beginners, the book by Hank Pruden, the three skills of top trading, is perfect book for the beginners. Then I would refer you to Bruce Frazier's blogs on stockcharts.com. Those are kind of like the beginners, intermediates, and there are intermediate, and there are some advanced concepts. But this is a really good transition. And then for those of you who are more advanced, David Wise's book, Trades About to Happen, is going to talk about a lot of the advanced concepts that are chart reading, tape reading type of concepts. All right, let's talk about his course, the Richard D. Wyckoff course. So this is an original course that was published in 1931, 1932. You could find this course in the public domain, but also you could go to the SMI website. This is the company that was created, I believe, after Wyckoff has passed in 1934 by Bob Evans, his student. And you could find it there. And I usually would say, if you're going to read something by Wyckoff himself, read this. Even though the language might, feel a little bit outdated, that's okay. You can get used to it. But this is probably the best sequential body of knowledge that he has created. Everything that is in the books, you have to kind of extract it sentence by sentence or chapter by chapter. So, definitely, this course is of interest to us. So definitely start reading it if you have a chance. Let's talk about the composite operator. So this is the heuristic that Wyckoff created based on his studies of the stock market operators of his time. And I want to point your attention to an article which is called The Composite Man by Richard D. Wyckoff himself in the Magazine of Wall Street. And I believe this was from, we don't have the year here, but something in the beginning of last century. And I want to point your attention to this paragraph, and let's just read it together. Who is the composite man, and where he could be found? He consists of some 2 million personalities scattered all over the face of Earth. So he's just referring, to the potential number of traders at that point of time. Some of his component parts are richer, more powerful than others. So here he's referring to the CO or institutional types that have a lot of money. They reach a lot of influence. They could, buy information at that point of time. They have a lot of analysis that they could buy, and so on and so forth. Some are noted for their foresight, intuition, shrewdness, conservatism. So these are analysts and maybe long-term investors. Some are for dash and daring, reckless quality of their moves, speculators. These millions of personalities form one, omniscient, who sways the market, crushing those who do not know, weak hands, and will not learn how to benefit by him, and crowning with profits and income those who do. So you could see that Wyckoff's definition of the composite man was somewhat different than what we taught in school, when we were studying the Wyckoff method. Usually the idea of the composite man was presented as an idea of the institutions against retail people. And this could not be further from the truth. So I just want to make sure that you guys understand this. Composite man is not necessarily an institution. Composite man, as you could see from Wyckoff himself, is a combination of different market participants. It could be the analyst who would be advising correctly in the direction of the current price cycle, price movement. So he or she is influencing the price action. And those are the behaviors by the composite man participants. Institutions that are on the correct side of the trade, those are definitely going to be composite operators. And we're going to go even into more details as to what kind of institutions we could possibly have there. And then also, I want to right away give you an idea that weak hands are not just public hands, and not just retail traders. Weak hands are also institutional traders that are on the wrong side of the trade, of the price cycle. And we'll talk more about this. Well, specifically, Wyckoff was thinking about stock operators of his time, like J.P. Morgan, James Keane, Jesse Livermore, and he had quite a few discussions with Jesse Livermore. So that is well documented in some of his books. And he would come up with the description of what the composite man is. So he would say that composite man would carefully plan, execute, and conclude his campaigns. He attracts traffic, he attracts the public into buying of the stocks, which he has already accumulated at the lower prices, and then he basically advertises the trend to the broad market and liquidates his position by dumping the shares to weak hands that are excited at that moment. And we could see this from the price cycle. We could see where those stock operators would start their campaigns, where they would be accumulating the shares, and where they would be distributing those shares. All right. Well, into some of the examples of some of actually my trades. Oh, and I have not updated this. So today we're going to look at cryptos, some of the trades in cryptos that I have. I'm going to discuss those. We're going to talk about Twitter as one of those trades, where we're going to look at the long-term trade and a swing trade. And also we're going to look at actually my past trade, not most recent, in futures and Q, NASDAQ 100. That was an intraday trade. So let's go into those. All right, so here are the positions in cryptos that I'm currently holding. The red arrow is pointing to the points of entry where I entered the specific instrument. So at the top, very popular Dodge, XDJ. So for those of you who are trading cryptos, you actually, probably very excited to see this chart. You could see the craziness that is going on where cryptos have some kind of move up and then they just consolidate for some time and they create specific structure. There is no activity. And then suddenly something happens. And then we're seeing how a lot of demand is coming in, whether it's on use or some buying, and then we have a continuation of that uptrend. So you have to be really patient. And I think that the long-term strategies in the crypto world actually work extremely well, as you could see from my trades. Currently, I'm not closing any of the positions. I have a very strong conviction that we're going to see more of the moves in the crypto world. So here's where we are with the Dodge, and it shows currently outperformance where Bitcoin is actually having a reaction on some selling, some liquidation by leveraged traders, and Dodge is actually staying up. So currently I'm thinking a trading range here. We'll just have to see what kind of duration for that trading range we're going to have, and then possible continuation. BAT, a good point of entry after we have had actually already a run up, consolidation as the reaccumulation, sign of strength, and we're entering on the backing up action. This is exactly what we would be studying as the points of entry, high probability points of entry for us in the specific places of the price structure. Another trading range, and I would be expecting still continuation as the targets are somewhere above $2. Then Cian coin, that was also a really good trade, or at least it is for now. Entering still in the trading range formation, going into another reaccumulation. I was not adding at this time. I was 100% invested. And then currently we're having another trading range that is unfolding. We'll have to see what's going to happen here. Tron, another good position that has shown quite a lot of strength on the way up, and we're seeing how currently we're still in the trading range. So again, We will have to see how this trading range unfolds. And the last position that I have is in Uni, and that one still yet have to develop. And to me, if you're a long-term investor, especially in cryptos, and I'm not trading leverage positions. I only trade cash positions. So you could see that in this case, there is definitely a follow through to the downside on the Bitcoin sell off. We are not making a progress to the downside, and we are stopping here, which is a good bullish sign. So we should be seeing some kind of attempt at least to go to the resistance. So hopefully this, and especially for those who trade cryptos, give you an idea of how I trade those. I think I'm going to be more active with cryptos going forward. We have an unbelievable talent at wyckoffanalytics.com, Alessio, who is an expert on the Wyckoff interpretation of the crypto world. So check out his blog. Check out our weekly Wyckoff crypto discussions, which are for now free. And then also check out our Discord group, which is that we've launched, I believe, in February. It is still free. There is so much good information and so many great traders, advanced traders that are willing to share with you all of the knowledge that they have. All right, to the next trade. So now we are discussing stocks, and we're discussing two time frames, campaign and swing time frame. This was the trade. These are two different trades and two different accounts. One is the institutional account. Yes, I manage money for an financial institution, and I'm acting as the co-manager of that particular institutional portfolio. So our long-term trade in Twitter was originated in August. This was the point of entry. There were additional add-ons. I'm not putting them on the chart. Just wanted to kind of show you the whole logic of what we're doing with the long-term campaign. As we go through the recovery of the COVID low, we're seeing how the most, meaningful reaction after COVID-19 reaction does not produce a lot of result. It stops at the previous support level. It doesn't have a lot of selling behind it. So that is suggestive of the accumulation and an uptrend. Demand is coming in on the last down bar, and then after that, off we go to the upside. So a change of behavior in this area, and we're opening position right after that. So this is a very high probability place. For the long-term strategy, we will not be concerned with some of the reactions that are not meaningful. So therefore, if they are in the context of the uptrend, we will hold on to the position. And then the second trade is a swing trade from my personal account. So I usually trade options. So I'm trying to pick up the spots for options trading where we're going to see some kind of acceleration of the price. So where momentum is going to accelerate, where we're going to see that demand is going to come and it's going to push the price aggressively, either to the upside or to the downside. So I think from this perspective, this trade actually satisfies that specific definition. And we're seeing, even though there is a lot of supply on these two reactions, the supply is diminishing from one reaction to another, and the downward result is diminishing as well. And then we have some, what we're calling a bullish feather. This is where the absorption of the supply still continues, and it suggests that once the price comes to the resistance level, this is where momentum is going to increase. This is exactly where we want to close our options position on the way up. We don't necessarily want to close it on the way down, as we don't want to lose the premium on options. So we're closing on not necessarily the most optimal place. We could have waited maybe a little bit just based on the momentum, one more push up. For a more detailed analysis of this trade, check out our Anatomy of the Trade videos on YouTube. Together with Franz, one of our advanced students, I record those on the weekly basis, and Twitter was discussed for both actually long-term and swing trade. Another example is the intraday time frame. This is E-mini futures, NASDAQ 100. I have shown this trade, so for some of you, this is not a new trade. We're seeing at the beginning of the session how aggressive demand is, pushing the price up, and then we're going into the upsloping consolidation. Upsloping structure shows strength itself, so this is another indication that potentially we might continue in the uptrending manner into the close for the session. But we do have a structure here. We do have a trading range. So we would apply our Wyckoff structural analysis, identifying a change of behavior that is suggesting a change of the environment from an uptrend into a trading range. Then we would be looking for the conclusion of phase A, intention of which is just the stop in action of the previous uptrend. And then we'll look for the tests in phases B and C. And we know that in phase C, we might have a test where supply might increase. That is where weak hands produce a local capitulation of their positions. And this is where strong hands come in and they are actually buying. So those are going to be institutional hands because they are seeing that there is some value here, short-term value. As they buy, our goal as Wyckoffans is to identify the reversal out of phase C and then just stay with the trend. So here is our reversal. I like those local breakouts, and then we're just staying with this trend. There is no violation of the support, and as we go into this area, there is something that might not be that visible by a naked eye, but as we study the price action more and more, you will be able to see this. So what do I mean by this? Look into this rally and compare it to this rally and then to this rally. What do you see here happening with the momentum? Can you observe how this spread is starting to diminish? And in the third case, on the third rally, we're seeing how the spread is ever smaller than it was at the beginning of the move on the previous two legs up. So the diminishing momentum characteristics are suggestive that if supply is going to come like it did here, we might develop some kind of reaction out of this. So the point of exit was actually based on the preconditions of the potential reaction. Actually, the price went up a little bit further up, and then it had a reaction, which was a change of behavior, and then went into the trading range, into the close of the session. But I would say that probably it was an optimal trade, probably one of my best trades last year in terms of the intraday trading, and it was a very pleasurable trade to be in. There were not a lot of like ups and downs. It was pretty straightforward, and hopefully that highlights to you the capability of the Wyckoff methodology. If you can sustain the year or two of hard work working on this in terms of the recognition of the concepts on the chart, and then working even harder on the execution, on the actual execution as to how do you execute the trade that you see from your analysis. One of the learning tools that we have, which I love so much, is our bias game. So we have different places where you could find the bias game. Well, first of all, go to our website and on the navigational panel, click on bias game, and you could find it in this format. Here is your quiz. You could expand this chart if you click on this, print it out, do your analysis, and only after that, look for the solution, for the answer to this game. And then go through the solution. And this is where we show you our labeling, we show you our bullet points of the analysis, and then we create the whole Wyckoff story as to what has happened. And on the top of that, we have this bias game playing out on Twitter, on our Wyckoff Analysis Twitter. So we posted each Wednesday, and then on Friday we post the solution to the bias game. This is how they are released. And then you have the capacity to vote as to what do you think. Is this accumulation or is this a distribution? And then you can measure up yourself against the crowd, against other people. I usually suggest, if you play this game, keep the score, and then in the practicum, which is the WGC2 course, the course after this on Tuesdays, we go into a very, very detailed analysis as to what is it that we needed to see in this bias game in order for us to solve it effectively. Students and myself have developed specific algorithm as to how we go about the solution for our bias games. So again, check those out on our website, on our Twitter, and then also, for those of you who are going to be students in the practicum class, we will be most definitely working with those in details. All right, so let's switch gears and let's come back to our body of knowledge, and let's kind of like go through some of the behavioral market analysis items on the list for us today to cover. Let's talk about our main objectives for the price structural analysis. We want to understand and we want to observe the market participants' behavior on the chart. It kind of sounds a little bit too much, right? Could we really do that? Could we really understand where institutions are present? And could we really understand where, let's say, weak hands are present? And I would say that with time and with practice, you could definitely see a lot on the chart. You could see where institutions are going to be heavily buying or heavily selling. You could see where weak institutions could be selling and strong institutions could be buying from them. You could see where the public is going to be extremely excited in the context of the price cycle, in the context of the uptrend, and where they're going to be extremely fearful. And all of that we could extract from the chart. Now, this second point is also very important. If observational skills are extremely important for us to recognize what we see, then correct deductive reasoning is also extremely important for us to understand the market participants' intentions. What is it that the institutions are doing at the specific spot? Are they selling or are they buying? And that's what's going to give us the answer to the question of the bias and the question of the timing. And then our goal is always just to trade alongside the smart money. And by the smart money, I don't necessarily mean institutional money, although we do mean exactly that. What I mean by that is that we want to follow institutional and strong hands money in the context of the whole price cycle. And the only way how we could do this from the chart is by making the correct observations and then making the correct deductions. And what would we use for our analysis? Well, we're using the concept of the price cycle. We're going to cover this today. We need to understand the behaviors of the market participants. That is covered in the behavioral market analysis. Majority of it we're going to cover today. We need to understand how the trend is unfolding. We'll cover that in the next session or so. And then we also need to understand how do we actually form the price structures based on those behaviors. How do we change behavior, and how does this change of behavior which is just a conditional thing, would materialize into the change of character, which is a structural characteristic. And then how do we form trading ranges out of those? So we'll try to cover as much as possible today. And hopefully, guys, if you feel that this is a valuable material for you, you could sign up, and we could definitely go through quite a lot of nuances and details, and just knowledge in general. I think that we are actually doing okay on time, so I might have some time for your questions at the end of this presentation, guys. So just stick around for those of you who have questions, and we'll try to address those. Let's talk about the price cycle. So four main elements to the price cycle: accumulation, distribution, and then everything in between: markup or an uptrend, markdown or a downtrend. And obviously, very obvious statements, very obvious axioms that we would have here related to the price cycle. Demand is greater than supply on the way up, and that's why it's an uptrend. And then supply is greater than demand on the way down, and that's why it's a downtrend. All right, well, what specifically happens during the accumulation? So this is a much more detailed schematic, so let's just go through that. As we are in the downtrend, we are going to see weak hands capitulating their positions, and that's what's going to produce the climactic run. And this climactic run is going to have several characteristics. The volume is going to increase, and it's going to become climactic, massive volume. The downward spread is going to increase as well, just because there is so much supply, and that supply moves the price quickly down. And it's not just that the weak hands are retail hands. That is such an erroneous statement when we would say something like this. And again, this is something that we've learned way in the past, and this is something that I'm trying to correct already for years and years and years, because it's not true. Institutional hands also could be weak hands, and it's because of their size that we have climactic runs like this. And I would be calling, the last climactic run a general capitulation. General means that we're going to have a participation both by institutions and by retail weak hands at the same time. And again, that's what's going to increase the volume signature. That's what's going to increase the velocity and the momentum of the price moving down. And we're going to see a lot of availability of the supply. Now, ironically, at the same time, this creates an opportunity for the CO to do what? To actually buy and start accumulating the stock. So, and why would CO do this? Why would CO buy when everybody is actually selling? Well, the answer to that is very simple. There are two things that the CO considers at this moment. There is most definitely a lot of long-term value that was created by the downtrend and where the prices are. The prices are depressed in the downtrend. And specifically going into the climactic run, the prices are at such low level that creates immense value for long-term contrarian institutional investors. They also are enjoying the liquidity at this point of time. What do I mean by the liquidity? It's the availability of massive amounts of shares from weak hands. As they capitulate, they basically tell to the CO, I don't want to hold this anymore. Could you take this off my hands at any price? I'm willing to take the loss. So please do this for me. And the CEO is just basically saying, okay, I see long-term value. I see a lot of liquidity. And I don't mind the trading range to be unfolding for quite some time, just because if I get at the correct price, it gives me, a good P&L look, and time is on my side because I'm a long-term price cycle type of investor. And with this buying, just because CO has size, we usually will see increase of the supply from weekends, and then we'll see increase of the demand from CO type hands, strong hands. And all of this will produce something interesting, a stop in action of the price where we're seeing a final selling climax low, and then with the absorption of this supply, the price will start going up. And as the price starts going up, a lot of professionals are going to cover their shorts. And what is covering of the shorts? It's basically a market order to buy back the shares by the professionals. That also triggers more upside, and the price is going up in the automatic response to the selling that we have had. This rally produces a change of behavior. And a change of behavior for us is something very, very unique. And even though it's a very simple concept, it's probably one of the most important concepts in trading, or like in the analysis itself. It just basically tells us that on this rally, the market participants are behaving differently than on the previous rallies in the downtrend. And that is suggestive of change, and not only characteristical change, conditional change, but also structural change. This suggests that from a downtrend, we might actually go into a different environment, which is from a trending environment to a non-trading environment into a trading range. To confirm all of this, in phase A, we have a secondary test. This is our confirmation that the price is no longer in the downtrending formation, but actually it stops and then recovers, has some kind of reversal, and we are seeing ups and downs, swing up, swing down, swing up, swing down, and that's what starts creating the trading range. Further into the course, we'll dig into the sentiment from different market participants and how that sentiment produces some buying or selling at the very crucial points at the support and the resistance. And again, this is how the trading range is being formed and continuously. Going through phase B, which I would call a preparation phase, and there are quite a few definitions on the intention there. I'm kind of reworking the whole material with my current understanding. So I would say that phase B, usually we would say it's a cause building phase, cause and effect type of phase, cause building phase. I think that cause building is actually an outcome of something much more important and meaningful of what's going on in phase B. Because of what has happened in phase A, where selling and buying has collided, phase B becomes more about exhaustion of that collision, and especially this second portion of phase B. And this is where we could start seeing diminishing volume characteristics. And that also produces some kind of inactivity by institutional types. And that's what creates or extends the causality of the trading range. Because if there is nothing's going on and the price kind of like drifts up and down and so on and so forth, that creates additional number of columns on the PNF chart and expands the causality, suggestive that the uptrend is going to be much more significant. Phase C is our last test. Test of what? Test of the supply availability at the level of the support. If supply has been observed through the action of the composite man at the lower part of the trading range, and usually that's exactly what the CO is going to do. It's going to buy at the support under maybe 1/2 of the trading range at the specific price range. And that's why the price will stop at this level. And again, CO will be buying at this level just because there is some value. And as they buy, the price stops from going further down, and then the price recovers. And other institutions are starting to pick it up somewhere in the middle of the swing, and that's what pushes the price even further up. And then at some point, this participation by other institutions, once the CO has sufficiently bought the shares and accumulated sufficient amount, and the absorption has happened in a very sufficient way, other institutions are going to join the party. We're going to call them institutional trend followers. So their market model, is based on the emergence of the trend. In this case, uptrend. So they're going to start adding demand on the sign of strength rally, and that's why the sign of strength rally is going to overcome the highs of phases A and B. And not only that, as they are buying in, the CO and those institutional trend followers are not going to sell on the first reaction, which is a backing up action. And this is where the behavior changes again. So as we're changing the behavior on the rally and the reaction, like we did here with the automatic rally and then the secondary test, we went through a trending environment into a non-trending environment. So here on the change of behavior, we're going from a non-trending environment back to a trending environment. That's what's going on here in the trading range. Our goal as Wyckoff traders is to catch this. We want to come in as early as possible into a trading range, and we will be discussing different spots in phase D and early phase E, which we will define as high probability structural spots for us to establish the position. We'll discuss where the failures might potentially happen. We'll discuss the timing of the price taking off of the phase C. We're going to discuss characteristics of phase C and phase D and how we would go about it. And then as the trend develops, obviously there will be quite a lot of other opportunities in some areas of the reaccumulations, some reactions where we also will be adding to the position, so establishing new positions. But the trend is going to conclude in the same way as a downtrend. It's going to conclude with this stop in action. So what happens here where we are stopping an uptrend? It is in the second part of the uptrend. This is where weak hands are actually profitable for the first time in the price cycle. Just think about this, right? So the trend has been established for some time. The trend has been advertised to the public. It has been advertised to the institutional weak hands. And now they are jumping on this trend and enjoying the profits, because this is going to be more of the speculative portion of the trend. And this is where we're going to see a lot of price movement, less supply, and a lot of weak hands are going to enjoy and make profits here. So that creates the increase in the weak hands participation. And what do weak hands bring to this party? Liquidity. And as liquidity starts to become available, contrarian CO types are going to sell into that strength. And they either going to take profits or they're going to distribute their shares. And as that happens, this is the only reason of why the price stops and produces a meaningful change of behavior. There might be situations where, let's say, CO does not sell and we still produce a change of behavior. Those are the reaccumulation type of uh, structures that would develop after the deterioration of the demand. But if we're seeing a significant supply coming in and that produces a significant result to the downside, most likely CO is either taking profits or distributing the stock. At this point of time, weak hands are still attracted to this particular asset. Why? Because short term, this produces the value. And they've just been in a situation where they made a lot of money in this particular asset. They will come back. And they will try to make more money. Their whole idea is going to be that there's going to be a continuation to the upside. And that's what they're betting on. Unfortunately, as CO sold into the strength and then into the change of behavior, CO steps out and now does not buy anything. So the rally is not that great. As the rally fades and the price drops, some of the weak hands are going to get out of this position because they are leveraged at this point. And, if the price goes down and it doesn't confirm the up movement, they might get out. This is how the structure starts to create with different elements, different variations, and so on and so forth. Some structures are going to unfold really quickly because there will be some urgency to sell. Some structures will take some time to unfold as contrarian CO types are going to sell into the strength, but there's going to be so much strength by different market participants that it will take multiple times to sell into the rallies and to stop, to finalize that uptrend type of movement. And it's when a true change of behavior and a true change of character happens, when the reaction extends significantly and it shows the ability of the price to commit below previous levels of the support on the increase in supply signature. That's when we're going to say that a change of behavior is unfolding. And from a non-trending environment, we might go into a trending environment. The confirmation of that will be inability of the rallies to produce anything significant what we've seen before in the trading range. So usually those last point of supply rallies are going to fail into the resistance. They're going to show a lot of weakness, or they're going to show a lot of strength without any significant result. And we are going to pay attention to this. And this is going to be our catastrophic exit if we have not exited prior to this. And by the way, don't worry, we will study all of the exits. What are the most optimal? Obviously, the most optimal are going to be still in phase A, early phase B, rather than this catastrophic stop loss. But sometimes we're gonna be in those type of situations, and we'll need to know how to behave. All right, and that's the whole price cycle from kind of like this theoretical point of view. We're still gonna obviously go into much more details. I'm giving you first a big picture, then a big picture with more details, and this is probably the next level here. Same chart, same idea of the price cycle, but now we want to understand that on the way up, it's not only in the accumulation and the distribution that we're going to have, those stopping preparation and go type of parts to the trading range. we actually gonna have those also during reaccumulations and during the redistributions. And reaccumulations and redistributions are gonna be a part of the whole price cycle. And usually those happen for the reasons that I've already outlined a little bit on previous slides. As the price moves up out of the original accumulation range, and let's say we're producing some kind of good P&L for those institutions that bought at the bottom of the range, some of them are gonna take profits. And by taking profit, we're going to increase the supply at this point of time. Increase of the supply is going to produce a stop in action, a change of behavior, which would suggest a change of environment from the uptrend into the trading range. And then we would be tasked again with our bias definition for this trading range, timing when the price will leave the trading range, and then the character with which the price should travel after leaving the trading range. So all of this is going to be our intense studies during this course as to how do we actually know when we should be taking profits together with the CO, how should we be analyzing the whole trading range, how should we define the timing of when the price is ready to leave the trading range, and then how could we aggressively participate in the next move up or in the next move down. All right, so here's an example of a very, very long price cycle. This is Apple. This is not even updated. We are definitely much higher somewhere here, so we'll have to update this chart. And we could see that we have a secular causality which lasted for what, a decade plus or so. This is where Steve Jobs comes back to Apple in 1996, 97. And then look at what happens right away. Changing the management, influx of his, pure genius into the company again. And we have a major sign of strength rally where institutions are present and they are buying aggressively. It's only being derailed because of the market conditions in 2000, 2001, 2003, going into 2003 low. But look how even this shakeout type of action creates a higher low trading range structure, which lasts for several years. It shows a lot of strength as the market was just basically doing this into 2003 low. So we're seeing that institutions are unwilling to depart from their positions in Apple, and they're willing, they are waiting for the new trend to unfold. And then within this larger, price cycle, which is still unfolding, we have smaller price cycles, right? So a small accumulation, smaller markup, smaller distribution, smaller markdown. Accumulation, markup, distribution, markdown. Accumulation, markup, distribution, markdown, and so on and so forth. So that just goes on and on and on. And we could anticipate this type of behavior not just on the long-term price cycles, but also on the intraday level, on a swing level. So that's why this material, when somebody comes to me and they say, well, I'm an intraday trader, could I really apply this methodology to intraday time frame? Yes, you can. And it doesn't really matter if we study it on the daily, on the intraday chart, or on the monthly chart. The principles are going to be the same. Another question, which is very common, could I apply it in different instruments? Could I apply it in Forex? Absolutely. Could I apply it in cryptos? Absolutely. Could I apply it to the futures? Absolutely. Could I apply it to low liquidity stocks? Yes. Could I apply it to any other asset that has the price and the volume signature? Yes, you can. So just keep that in mind. All right, let's talk about the behavioral market analysis. Those are the studies of market participants' behaviors in the context of a price structure. So we've already went through this slide, but I just want to reiterate the whole idea of what strong hands and weak hands are doing at the specific points in the price structure. So on the way down, in the downtrend, this is an extreme point of fear for weak hands, where they capitulate. The strong hands will show the first signs of intelligent accumulation. And this is what's going to stop the price from going further down. And this is where the price is going to consolidate just because of that buying. And as absorption unfolds throughout the whole trading range, then finally the price will start to go up. It's in this area right here, in the emergence of the uptrend area, where accumulation by early institutional trend adopters would happen. Again, those are smart institutions that have models recognizing the beginning of the uptrend, and they are making their bets here and therefore increasing that demand signature. Whereas weak hands, on the other hand, are going to be exhausted. They're going to be emotionally exhausted by the downtrend, by the trading range, and everything that's going on right there. So what are they going to do? They're going to be either still selling or conducting short-term trades or be inactive. It's almost that the inactivity acts as the withdrawal for weak hands at that point of time. And they don't even want to look at that chart because they've produced so much pain through all of the trades in the downtrend and in the trading range. All right, well, as smart institutions are getting on this uptrend, the uptrend is intact, sustainable. It travels up. Then, as I mentioned, in the second part of the trend, which is going to be advertised by the tape itself, we are seeing the first signs of intelligent distribution by strong hands. And it only happens because weak hands are at the point of excitement. And therefore, they're providing more and more liquidity. They're getting more money into the market at the spot. And CO is just selling into that. CO will be selling throughout the whole distribution if necessary, if all of the shares were not distributed at once. And usually that would be done in the upper part of the distribution. And that's why in a lot of cases, you're going to see the price go up, and then you're going to see some kind of big volume spike, and then the price will reverse down. So what does it mean, this big volume spike? Well, the volume spikes are very, very useful for us. We're going to see that even though there is some demand that is pushing the price up, supply is present. And that supply could stop the price from moving further up, produce some kind of change of behavior that would suggest a change of behavior, and we might potentially go into a trading range or something like that. And then by the time that distribution by strong hands has been done with an idea that they're selling into strength, their next distributional actions are going to be on the way down. So as they sell, the price goes down. As they sell, the price breaks down. And we'll study those more in details. Whereas we can still perceive this trading range as a value. And therefore, they will be coming in at the bottom of the range, thinking that this is a very good place to open up the trade. And it is for a moment. But then as the price fails, obviously, what are they going to do? They're going to start capitulating. And that's what's going to drive the prices down. All right, well, as we talk about strong hands and weak hands, let's identify the places of where they actually buy, sell, or being inactive. So, strong hands are going to be buyers as the prices are going down, as the prices are showing some value, as there is some kind of liquidity in the marketplace that provides strong institutional hands or strong hands with the ability to buy big positions. So think Warren Buffett here. Think something like like PIMCO, those type of institutions. They also will be buying on the way up as the trend emerges. And those are not necessarily going to be just the CO types. Those are also going to be institutional trend followers. Again, we've talked about how they define the emergence of the uptrend. And this is where they want to load up on the way up. And then they become inactive. So the trend is sustainable. The trend is well advertised. So weak hands are going to come in, and weak hands are going to be buyers. And as they are starting to buy, selling by the CO is going to happen into the strength, then selling by other institutions are going to happen on the way down, and they are getting out where the weak hands are still buying at these levels. And this is how the weak hands uh, schematic is going to look like. They are selling on the way down, capitulating. They are selling as prices rally. Then they are so exhausted with this downtrend in the trading range, they become inactive. So total withdrawal. And then they start buying only when the trend is already in the last phases of its existence. And they will be buying into the distributional trading range, thinking that there is a value here. And this price cycle will repeat itself over and over and over again in any instrument where we have institutions with a lot of money and institutions with weak hands that might potentially have a lot of money, but not necessarily be on the correct side of the trade. Okay, so here is this example. We're still discussing the Apple. This is the monthly chart. So I mentioned this area right here. This is where institutions are heavy buyers. So they want to be present in this stock, in this theme. And they were buying as the prices were falling. They were buying on the way up as well. They were buying as the prices were falling here as well. And then look at this volume signature. What does it tell you? There are more institutions now participating in this trend than in the late 90s, and they are buying on the way up. Why would they be buying on the way up? Just because they believe that the price could go even higher. And that's exactly what happens. There is still some buying, but not as much on the next leg up, but they are definitely less active. So it's almost like their portfolios by 2013 were populated with Apple as one of their main core ingredients. After that, they don't need to establish more positions in the stock. They just are riding the trend, so they become inactive. Ironically, this is the last segment of the uptrend, but because this is a multi-decade structure, it could unfold for some time. So we'll have to see where the end is going to be for this particular price cycle. Here is the same Apple chart, but on the weekly basis, and we're looking at the smallest structure. So here is that accumulation when Steve Jobs came back to the company. We're seeing a very aggressive rally. We're seeing the buying on the way down before that. We're seeing that the next reaction, even though it retraces all of the gains from the rally, but it stops at the level of the support and then buying comes right away. So they're buying on the way up right here. They're buying more in the trading range right here, in the reaccumulation trading range, and less so on the way up. And look how demand is starting to diminish. We would be saying that demand started to diminish in this area right here, yet the price is still going up. Yet we still see some kind of follow through to the upside. And then during the distributional range, demand is totally exhausted. And based on the market conditions, not necessarily on the stock itself, a strong stock cannot sustain its position because of the gravity of the market itself. And again, we'll talk a lot about that relationship of the market influencing leadership stocks. In which way? And we'll talk about that for sure. All right, let's go to another time frame. In this case, we are on 2 hours for Apple, and we're seeing the same things happen. There is increase in the volume signature, which is suggestive of buying on the way down. Then there is increase of the volume signature and price increase on the way up. So they bought here, they bought here, they bought it on the way up. Reaccumulation after that without any significant selling, so suggesting continuation, and the price continues to the upside. This is where they are starting to sell. It's like the price goes up, but then stops. Stops because the volume comes in. So what's going on there? Some selling is happening. Selling from who? From institutional hands, not from the, let's say, weak retail hands or weak institutional hands. And that's what temporarily stops the price from moving further up. But momentum is too strong, so there is a continuation until the next point of selling. And we just want to recognize that and look at the result of it. So what is the result? It's a much more pronounced reaction than we've seen in this uptrend. And that acts as a change of behavior, and that suggests either further prices down or some kind of trading range at this point. All right. Let's talk about the price cycle market participants. We usually would say, okay, strong hands, or we usually would say CO. While I mentioned another type of institutions, institutional trend followers. So this would constitute the majority of buying and selling power in terms of its size. We also might add here professional traders. Those also have some size, but not as much as others. And then let's also discuss the weekends. Who are those? So institutional contrarian investors, those are value investors. They will be buying as the price goes down, and they will be the first ones to say, like, there is value here, I'm going to buy here. So think Warren Buffett here. That will stop the price from moving further down and will produce some kind of rally. That's how the trading range starts. Their size is huge, and their time horizon is all about secular and cyclical moves. They are looking for the long-term value, short-term liquidity, and some kind of contrarian sentiment. Why would they do this? Because it's easier to buy huge positions, and that's what they want to do. They have so much money that they need all of those three characteristics: long-term value, short-term liquidity, and contrarian sentiment, being contrarian to what is going on in the marketplace right now in order for them to establish a meaningful position. If they don't do that at that spot, they will most likely at other spots be pushing the price up very, very, very much. So they don't want to do this. They want to buy at the wholesale discount pricing. Their limitations is also their strength. They're too big, so they can't have a high turnover. They usually have low turnover in their portfolios, and they are also very much concerned about tax implications. So their holding period is going to be very, very big. Their edge is in that time holding period. That would create long-term trends, and they also have a very, very deep knowledge of the marketplace and the behaviors of different market participants. They are visible to us on the chart, and this is what we're going to do during this semester. We're going to study the ways of identifying strong hands and weak hands on the chart. So they will be visible behind the extreme volume signature, behind the points of liquidity, behind the absolute and relative trends, and long-term value signatures. And the examples of those type of market participants are going to be, in general, just a composite operator, somebody like Warren Buffett, PIMCO, BlackRock, and so on and so forth. Billions and trillions of dollars that are being managed by this type of institutions. The second type of institution is going to be institutional trend followers. They are more of the growth story. Their size is big, and they are relying more on the cyclicality of the price cycle. They're looking for the emergence of the trend and the break of the trend. They're looking for long-term values and short-term liquidity. So very close to the CO, itself, right? The contrarian investor. Their limitations are going to be related to the performance matrix. So those are usually going to be money managers like myself, or registered investment advisors, anybody who manages the money. They will have to make sure that they outperform and that they outperform the market itself and then the peers. So therefore, because of this, they're going to have specific behaviors in the marketplace that would produce buying and selling, which in effect will create a specific structure. They will be concerned about the assets under management, low turnovers, and tax implications as well. Their edge is, again, a long-term time horizon, long-term trends, and deep knowledge about the markets. They will be visible to us on the charts based on the absolute and relative trends, long-term volume signatures, and momentum buying and momentum selling. And the examples of those are going to be pension funds, insurance companies, investment banks, mutual funds, hedge funds, registered investment advisors. So I would say that this first two is where the majority of the size is. So imagine if some of them become wrong on the trade, right? I mean, like Warren Buffett has described many trades where he was wrong, and that is, deserves so much respect. And obviously, he is very visible with all of his trades, but his somewhat recent failure in IBM when he came in and had to liquidate the position, I believe it was in 2017-18. Um, those are the type of traders and institutions that will truly create the structure, a price structure in the marketplace. So we need to understand who they are, why they behave the way, how they behave, and how could we find their footprints on the chart. Professional traders are still going to be the ones that are going to be institutional traders. But they don't have that type of size. They're usually medium size, and they base their strategies on the momentum on mean reversion trading. Their time horizon is so much smaller. They could be on the intraday, or they could be on the daily time swing, but they're not very long-term oriented traders. They are looking for short-term overbought, oversold condition, and presence of the momentum. Their limitation is that they're making too many trades, high commission, although this is less relevant now, short-term taxation, and lower size. But their edge is their quickness, going in and out. Excuse me. They are visible to us on the chart behind the momentum, behind volume, liquidity, and short-term swings. They are proprietary traders, retail traders, registered institutional advisors, and maybe some traders within some of the institutional types of financial institutions. Retail traders, us, right? So we're going to mostly base our strategies on the momentum. Small size, dailies is the most common time frame that we would use. Breakouts, points of excitement or points of fear. Our limitations are going to be is that we are sentiment driven, and this is what we are studying a lot in the course, how not to be driven by the herd sentiment, how to recognize what is the contrarian trade right now that is happening now. Usually, this type of traders will have lower knowledge and lower skill. And the course obviously addresses both. So this is our intent here, to study deeply how the market uh, behaves, answering the question of why things happen the way that they do happen, uh, and then building the skill of recognizing the conditions, and then skill of executing the trade based on this knowledge. The edge is the quickness, and we could define different rules for the strategies. We are not necessarily that visible on the chart, and yeah, and this is an example of us. Okay, well, let's talk about, where do we actually see now in the price cycle. You kind of could see that I've been building up different layers, right? Different layers of knowledge as to who the market participants are, what the price cycle is, what is the accumulation distribution markup markdown, and what is the sentiment throughout this whole price cycle. So this is going to be the most detailed schematic for us, where again, and this is something that I do a lot with my teaching. I repeat stuff a lot because I'm giving you so much information during a single session, and you have to follow that and observe that knowledge. Well, there is so much sometimes that students say that it takes them several repetitions or several even coming back and watching the video again, where they are picking up a lot of different nuances. So you will see throughout the course a lot of things that I'm going to repeat over and over and over again. So let's repeat them. In the downtrend, weak hands are selling. The value buyers are buying at the lower part of the trading range. And then the trend followers are still inactive. For the trend followers, they need to see the emergence of the uptrend. In the emergence of the uptrend right here, weak hands are becoming inactive because they are tired of the downtrend in the trading range. Value is still buying. It's still relatively cheap for them if they're thinking about the ultimate target somewhere at the top. And then trend followers are finally buying. So that increases the volume signature on the demand side, and that pushes the price up out of the trading range. Then during the reaccumulations, weak hands are starting to buy because they're seeing that the short-term trend is established, it's up, whereas the value is starting to take profits, and this is where the weak hands are going away again. So they are trying to get into this uptrend, they are encountering selling into their buying, and then they are just giving up during the trade range at any point. But the trend followers actually could be buyers at this spot. And this is what's going on predominantly around this area. The trend followers are still buyers as they started buying early on in the uptrend. And then the CO is taking some profits. So there is an active exchange of shares between two different institutional types. And this is usually how reaccumulation would start. And with that, then we go into the exhaustion phase, final test, and then the price will start going up. And this is where, again, trend followers will be buyers. Value is buying at the bottom. And weak hands, exhausted by their attempts to get into the uptrend, are inactive again. So poor weak hands, right? So we're seeing kind of like this broken sentiment mentality, broken market behaviors for weak hands. And that's why weak hands are consistently losing, and only at the certain spots, like, the final moves up, where the trend is already established and it's screaming at you, where this is where they will be most effective. And I'm talking about the weak hands. And so on and so forth. So we kind of could see how this all unfolds. With the distribution, weak hands will be buyers, value will be selling, distributing into the strength. and then trend followers will be still buyers. Trend followers will be selling as the trend is broken, break of the trend. And value is going to be inactive at this point, allowing the price to drip down under its own weight and under the weight of the selling from the trend followers. That's what's going to break the pattern, and that's what's going to establish the downtrend. And then early institutions are going to sell first, then late institutions are going to sell first, and then general capitulation will happen into the end of the downtrend. All of that we're going to discuss in more details under the trend characteristics and market participants' behaviors in the trend. This is a part of the body of knowledge that I'm going to give you in this semester. Example of CO value contrarian buying, and also trend institutional trend followers emerging in the uptrend. So we're seeing that Apple, this is a daily chart, 2011, a trading range, and we're seeing that there is a lot of volume spikes here. This is how they are buying. This is an indication that they are buying behind the price and ability to go further lower, and the effort or the volume signature expanding. It shows the emergence of the demand. And what is the resolution of this buying? A rally that outperforms the market back then in 2011, and a sign of strength and the backing up formation as a trading range. And even in this structure, we see a lot of buying on the way down. So again, value institutions are buying and they are anticipating higher prices. As the price starts to go up, it starts attracting other institutions, and specifically trend followers. So this is where their size is coming in. A little bit late into the uptrend, but they still participating here. And as they push the price up, this is where the CO types, value investors, which is usually contrarian in nature, are going to come in and start selling. And as they sell, something very interesting is going to happen. A change of behavior starts to occur, and that is suggestive of the trading range. And then we go into the trading range. They will do so again at the next higher level of prices. And then institutional trend followers are going to sell on the way down as the price is incapable of continuing to the upside. And we kind of could see how this rotation of different institutional market participants is happening. They have different spots where they buy, they have different spots where they sell. But if we do understand where exactly which institutions are buying or selling in the trading range and in the uptrend or a downtrend, we could pinpoint to the specific locations of where we are in the structure. And then obviously putting our Wyckoff layer on the price structure, that would even allow us to identify the timing of where the price moves out or moves back into the trading range. All right, let's go into another slide. Oh, okay, great. We're at the end of our presentation and we are at 5:15. Awesome. So again, a mandatory assignment for students who already signed up or who are going to sign up for this course. Anatomy of a Trading Range by Jim Forte. You will find that the video of this class will be posted into the class page, which is, we're going to send you tonight the password to that page, so you'll have the access. And also we will post it on YouTube, so you could watch it from there. That's only for the first session. You will find the article also being on the class page, or you could go to our website and under the free materials, you could find that article. And your homework is just to read it and to read it thoughtfully, and then come back to the class with maybe some questions that we will address in session number 2. For those of you who are still thinking whether you should do this or not, well, first of all, obviously take your time, but don't take a lot of time, because I want you to start working on this, on homework assignments, and I want you to read more, educate yourself more before the next session. If you have any questions, email me at wyckofassociates@gmail.com and we'll answer those. For those of you who are ready to register, go to our website, go to WTC Part 1 course and register and start working on your homework. All right, well, with that, let's see what kind of questions we have at this point. And I will try to figure out which questions to go to. Okay. I think we've talked about gold and silver, so that's great. Okay, so a question from Charles here. I will have to come back to a specific slide when we've talked about this. So if you could identify that for me, that would be useful. Okay. George is saying, I signed up and paid for the crypto reports and Discord channel. Okay, George, could you please email us and we'll definitely handle this. So just email us at wyckofassociates@gmail.com. Can we get a link to the Discord, please? The link on the site does not work. Yeah, it changes, so we'll definitely we'll update you. So just email us and we'll update you on the correct link. What do you mean by the deductions? Well, deductions, observations obviously is very common word. Deductions is just your logic as to, based on the observations, what kind of solution to the bias game basically you are going to come up with. So we are deducing what could potentially happen next. And we also, it's very important. I don't want to ever say that we're going to predict what the price is going to do. This is kind of like a point of contention for me with some of the people that are saying like, well, how is it that you're not predicting? What are you doing? Well, I'm just outlining the scenarios of possibility, and then I want the market to show us which scenario is going to unfold. And that way, it's much easier to follow the market. Okay, so from Vincent to look at some of the crypto. Okay, we could do this if we have time left. Can we get the copy of the slides? Yeah, absolutely. If you are a student of this class, or if you're going to sign up, we're going to give you all of the slides for this session for sure. If the market doesn't apply short selling, can we still see the automatic reactions from Tariq? Yeah, absolutely. And we see that from Saudi Arabia markets, we see this from Chinese market, or any market that doesn't have short covering. Automatic reactions are still there. How do they occur? Well, there is some buying that occurs on the automatic rally, let's say in the accumulation. If we are in the distributional pattern, then automatic reaction will be based on the selling into the strength of the rally that institutions do. So really good question there. From Anand, can this methodology be applied to any instruments on any time frame, including currency futures and forex? An absolute answer to this is yes. We do have some of the forex analysis. It's not very consistent at this point, but I think in the future we might actually have that as a feature of our portfolio of analytical tools. I've traded forex myself for more than 5 years. I do not trade forex at this point. It's just I'm not too young to trade forex, because you have to be available Cryptos is kind of enough for me in terms of trading 24/7. But Forex, definitely the biggest problem there is the volume signature, right? Or availability of the volume signature, or rather availability of the correct volume signature. So how do you deal with that? Well, first of all, there are some volume signatures that you could apply to your analysis. That's number one. Secondly, you have to learn how to analyze the price structure without the volume. And this is one of the things that we develop with students in the practical class, which is the course after this. This is a little bit more advanced skill, but it's possible and it's very successful, and you could just use the price for your analysis. All right, from the operators, and I would assume stock operators point of view, what's the difference between profit taking and the distribution? From Julian. Well, a profit taking is just going to be based on diminishing the size of institutional position, but still staying in this position for a longer duration. And the size could be diminished based on the current overbought conditions that could be temporary at that time, on the rebalancing of the portfolio where an institutional money manager needs the money for something else, where let's say the velocity of the portfolio could increase if you invest the money into some other instruments rather than being the one that might be in the consolidation. Whereas the distribution for institutions is basically giving up on their positions. That's the biggest difference right there. Are we in the point of the market where the market is being advertised to the public? Yeah, I would say that we are there. We are not in the most speculative phase of the current uptrend yet. But definitely, I see more participation by the public in general, by the retail traders. We've seen this off the COVID low. We need to recognize that the speculative phase could continue for quite some time. I mean, think about 2016 and 17 run. Think about the 1998, 2000 run. It took some time, to produce that speculative way. So it might really take some time to unfold. Okay, another question on Forex. And I think that I'm kind of answered this. So the question is about the float. Again, I would say that for Forex traders, understanding of the structure, and by the way, we have so many Forex traders that are taking our course. And the idea there is that they are learning the foundations of how you need to analyze the structure. So with Forex, the price action is of utmost importance. And this course definitely will help you out to understand how the price structure should unfold, right? So how does the uptrend stops? How does it go into a trading range? What's important in the trading range in terms of how the price behaves there, and so on and so forth. So again, still, I would suggest it for Forex traders, absolutely. Does the course include teachings on tools such as cumulative delta or unbalanced volume on different time frames? So my goal here as a teacher in this offering, that is basically a foundational offering for us, is to go to the basics, meaning that you're gonna work a lot with price and volume and time. And sentiment. So those are the four primary data points that we study. In further classes, like in some specials, I would discuss unbalanced volume. I would discuss the cumulative data, or we would just go and look at David Weiss's cumulative wave and so on and so forth. So we do this, but not at this level. Basics is the key for me, for you to get, and then to kind of cement them with a lot of practice. So that's what I do as a teacher. Do you cover open interest and volume? No, we do not. But again, something that you might find in further material. Okay. Okay, Charles. I'm wondering, as future Wyckoff traders, are we looking to be in positions in anticipation of the volume climax and then exit, or are we looking for that climactic action to happen, then do our analysis and find the best opportunities to get into the position? Okay, well, Charles, good question. So it's on tactics. So let's say that we are at the climactic action. So what do we do here? It just depends on who we are as traders. So let's say if I'm a long-term investor, would I be interested in the climactic action? Probably not, right? I'm not a CO type, so I don't want to go through this whole trading range and kind of park my money without high efficiency use. So I want to get in somewhere here in the potential phase C and D, where the price starts to move up. So I want to actually act more as institutional trend follower rather than the CO itself. But if I am a swing trader or intraday trader, then most definitely this is a very interesting spot for me, because for the intraday traders, there is a lot of volatility here, both on the upside and on the downside. So the more volatility, the more profitability for intraday plays. And then also as swing trading into the high of the automatic rally, that's something that we definitely could use as swing traders. So a very interesting question, and thank you for asking that. Okay, Joe is asking, is WMD included in this course? So we had a promotion which is lasting until this Wednesday, where WMD was included. Usually I do invite all of the students in this class into the ending sessions to attend some WMD sessions as well. So you'll have that opportunity, but not for the duration of the whole of the core course. And then the second question from Joe is, could you send out the link to the Discord group? Yes, for sure. Let me figure out the way how we could do this with this particular group. But if you don't have it, just email us at wyckofassociates@gmail.com, and we'll gladly provide it for you. Okay, next question. Could you explain spread in technical analysis? So I'm going to go with the basics. The difference between the low and the high of the bar is a spread. If we have had a gap, then from the previous close into the high, if this is an up bar, this would be a true range. Okay, and I'm just going to leave it at that, Rick, just because, there's a little bit more to that, and we go through that material. Next question. This comes from Nathan. Do you see an accumulation or a distribution on the very short time frame, such as 1 or 5 minutes? Yes, absolutely. And you could go even to a tick data, and you could still find those. Okay, next question. What from David, which could be the difference between the whole, what is the difference between the whole 12 webinars and 15 webinars for fall and spring semester? And I've explained it at the top of this session. Basically, same knowledge, we just do a little bit less of exercising. So that's what it is. From Julian, could I take concurrently WTC 1 and 2? And my answer to that is profoundly no. Unfortunately, and I know that this could be disappointing for some of you, usually we have, some people that would come to with this question at the beginning of the cycle of the semester, and I've tried this before. People come to me and they say, I've studied under this person, I've read this book, I've read this blog, this article, and so on and so forth. All of them who I've allowed to go and do WTC1 and WTC2 have failed in WTC2 class, have failed to be on the same page with us with the semantics that we use and to have the same kind of like depth of knowledge. And majority of people who came to me with this request later on, after taking WTC1 course, they've taken that was the best decision because of how much more is being given to them, and they would feel totally uncomfortable and, more importantly, distract everybody, including myself, from what we are studying in WTC2. It's just not efficient, not useful, and I have stopped doing this, and I'm extremely kind of like strict about that. Okay, next question. From Suresh. And guys, I'm really sorry if I'm mispronouncing some of your names. I know how it feels because my name is being mispronounced almost every day. How does activity on Robinhood and dark pools affect the volume of activity? So I wouldn't say that there is anything new about the Robinhood in terms of how the history of market participants unfolds throughout, a longer term picture. I mean, like a Robinhood is just representation of retail hands kind of becoming more visible. Well, did we have it in some other places of the market history? Well, what about when internet became more popular in the late 90s? Remember that day trading uh, boom that we've had? It's kind of reminiscent. So if you've been around for some time, you kind of see those splashes of retail activity that come and go. They usually come either with some kind of new innovation or when the market is becoming extremely volatile and more people are drawn into the market. And it usually slows down and goes away when the market goes through very prolonged series of depressed prices, like from 2000 to 2003, from 2007 to 2009. In during COVID reaction is less so because the duration of that was really short. So it's usually at those places, when the public starts to go away because they lost money, they kind of blame the market for some of the things, that have happened to their portfolios, and so on and so forth. So it's not a new occurrence. The dark pools were there for some time. I mean, what is the dark pool? It's just basically institutions are trying to cover their own presence with specific type of orders where they break down the orders into different parts, and maybe trading over the overnight with each other. So could we see that? Yes, we can. Well, you could go to the overnight chart of any stock and see what kind of activity is happening there. Futures is 24/5, cryptos 24/7 right now. So you have a lot of capability, to address this type of questions. I would add here the high frequency trading and algo trading. So those are also very common questions. Did they affect the methodology from 100 years ago? No, the concepts. If the concept is true, if the concept leads you to the truth of the chart, this concept should never change. And the reason why it's not going to change is because people are people, as I always say to my students. People are people, so they're going to just exhibit the same behavioral uh, behavioral elements, the same type of sentiment and change in sentiment at the same structural spot. So people from, let's say, 100 years ago would behave the same way during the selling climax as they behave now. They would behave the same way at the buying climax as they were behaving, 50 years ago. It's the same. It's fear and greed. That's how we are constructed for the survival purposes. And therefore, that's how we are going to behave now. Our goal in this, with this course, and just, you know, being better traders, being better analysts, is to understand this dynamic. Not only understand this dynamic with crowds themselves, but also within ourselves, because sometimes we will be weak hands and sometimes we will be strong hands. It's our idea that we need to transition more from weak hands behaviors into strong hands behaviors. So we need to behave like those big contrarian value and growth type of institutions and understand how on the chart we could be identifying the spots of high probability trades when the sentiment is extremely bearish. That's what we're doing here. All right. Next question. And we have maybe another 5 minutes or so. Francis is asking, when a sudden flash crash of 15% occurs across all coins in the crypto space, did the CO give rise to the drop? I think that when we look at what has happened over the weekend, so I'm just going to use that. When we see, and let me just put on the charts here. So when we see, and look how, volatility still remains very high. So we are heading to lower prices. We could break this 50, this level in Bitcoin. Let me just double check where it is. All right, look at this tail. So the key for us is just to hold this level, right? So preferably somewhere in the vicinity of the close of this bar. This is a 4-hour bar, or higher, right? So we were doing actually really well until we started this session or so. We will need to see if we're going to retest the lows. But the lowest close was here. So this is a very important level as well. If we're going to close below, then we're going to be questioning, would we go through this level or not? And that increases the odds that we can, if the close is going to be below the lowest close here. But back to the question, I mean, does CO do this? So to me, this bar right here, this is more of the weak hands capitulating their leveraged positions. Did CO sell? I think maybe some profit taken. I do not consider this, a distributional look by the CO. I would be thinking that CO would be more visible as the price goes up because CO does not want to sell on the way down. This is not CO's behavior. This is more the behavior where leveraged players are capitulating and they have to give up their positions just because of the price movement down and their leverage in this position. Charville is asking, can the Wyckoff method be applied to investing? Actually, I think that long-term time frame is one of the best time frames for this methodology. It doesn't really mean that it cannot be applied for a swing or intraday. I've shown you examples where I apply to all of the time frames and it works. right? So you just have to develop the skill as to how to apply this. But yeah, any time frame, any instrument. Is this an appropriate course to take for a beginner? Uh, well, if you felt comfortable with today's material, then I would say yes, absolutely. If you feel uncomfortable with today's material, then I would suggest our basic Wyckoff course, which is basically a charting course where we talk about very basic technical analysis concepts like an uptrend, moving average, and how we could think in Wyckoff terms about those conventional technical analysis uh, concepts. Okay. Konstantin is talking about low liquidity instruments. Um, do we trade this with different rules? So there are definitely, Konstantin, like variations on the analysis right there, right? Because the periods of inactivity, like the periods of inactivity in crypto space as well, are going to be quite substantial, right? So you're going to go into the high level of activity in low liquidity stocks or low liquidity instruments, and then you're going to go into um, the opposite of that. So all of your scans and selection as filtering is going to be based on the recognition that the high liquidity times are here for this particular instrument, and then you want to participate. That's the biggest distinction in the selection right there. Everything else is going to be somewhat the same. There are some nuances on trend following there and profit taking and exiting. Those are slightly different, but still in line conceptually with the dominant concepts in the methodology. Okay. Okay, what else? When you analyze the market with this method, are you still looking for the long-term trends? I start with long-term trends and then I go down in my time frame. That's the usual thing. Will this course cover P&F charts? Is this the preferred method for predicting a price move from Nelson? This course specifically do not discuss P&F charts. We have so much material on the P&F. You could start with the free videos by Bruce Fraser or his blogs. So those you could find on our YouTube channel and on stock charts on stockcharts.com. And then we have like 9 sessions, which are on-demand sessions, where Bruce and I go into such details on the P&F, how to construct accounts, which line to take into consideration, how to segment the trading ranges, how to look for confirming counts, how to use the timing techniques for any type of reconsolidation patterns, and so on and so forth in different time frames for different instruments. So check that out. Okay, well, interesting. Okay, so maybe right here we're gonna stop with this last question. Okay, so what would be another course you could recommend together with this course? Would the tape reading complement this at the same time, and or will we cover that knowledge in this course from Josh? So if you have time, and I'm going to be very blunt with you guys about this. This is not necessarily your kind of like walk in the park type of course, right? This is the course that will require a lot of time commitment from you. Each homework, depending on your level of knowledge, might take up to 2 hours even. One of the home assignments is going to be to watch the recording. So you can imagine that you increase the number of hours there. A lot of people might come and they might feel a little bit overwhelmed. One of the phrases that our students use, it's like drinking from a fire hose. And that's why there are specific ways of how we give the material, how we construct the homeworks, what I require from you guys in terms of the participation in the course itself. So based on that, I only would recommend somebody taking something else during the duration of this course only if you feel comfortable with the material, only if you feel comfortable following all of the homeworks. I would rather you do the homeworks than take another course, because you can take that other course at a different time. That probably would be my answer to that. Okay, with that, I think that that's it for today. We went 15 minutes over. Thank you guys so much for being here, for participating, for submitting your questions, for being such good listeners. And thank you for those who are signing up. I'm seeing the sign-ups are coming in. So I'm looking forward to working with you. Please don't forget, do your homework for next week. Read James Forte's article. That's number one. And then secondly, make sure that if you have any questions, definitely, let us know, and either me or Nancy will answer those. With that, the video of this particular session will be available tonight on the Wyckoff Trading Method YouTube channel. Check that out again. And then again, if you have any questions, email us to wyckoff@gmail.com. Thank you so much, and I'll talk to you next week. Bye-bye, guys.